Hey, thanks for coming, everyone. I'd like to introduce Professor Mario Crucini. He's the Jerry and Rosie Semler Chair in Economics and Research Associate with MBER. His research focuses on stochastic dynamic general equilibrium modeling of international business cycles, micro and macro aspects of international price determination, and the role of commercial policy during the Great Depression. Remember that. Kind of scary, but I think we need to be thinking about it. He's the founding director of the Center for Inflation and Price Research, co-founder and co-director of the Midwest Macroeconomics Group. He served on a variety of editorial boards, including the Journal of Monetary Economics, Journal of International Economics. So the main point of today's workshop relates to his work really over the last 3 decades. He's looked at economic developments early in the 20th century. And you may have heard about the Smoot-Hawley tariffs, for example. In the future, we're probably going to think about the Trump tariffs in the same way. It's a period of history that's really relevant to today. And so really interesting that he's been studying this for 3 decades and can shed some light on that historical period. So his first paper in this line of research appeared in the Journal of Monetary Economics in 1996. And he was trying to better understand the macro effects of these tariffs. And at the time, trade shares were small. A lot of macroeconomists discounted that as a role, playing a role. He pointed out that, hey, all of your macro models have one sector. Where are the intermediate inputs? And he thought about other dimensions of the problem, which brought more realism into that. And so he was able to show that despite that small share in trade, these tariffs played an important role in the macro impacts of during the Great Depression. And of course, intermediate inputs, that's what we're all about. That's what you guys putting together the database, that's thinking about where do they come from, where are they entering the economy. So a close link to what we do with each GTAP. Also, this link with the dynamic stochastic general equilibrium modeling, something that we're very interested in the center, very interested in engaging more with central banks and bridging to the type of modeling they're typically doing. So Professor Crucini's most recent paper on this topic appeared in the Journal of International Economics just this year. And there he looks at the role of trade cost frictions in the early 20th century adoption of the automobile. So you had a lot of automobiles in the US, slower adoption elsewhere. What explained that? And so here he dug into trade data, tariff data, tax data, all the kinds of things we look at today, a century later in GTAP, and identifying their role in explaining the slower adoption in other economies. So there are so many areas of overlap. This is long overdue workshop, but the point today is to have him talk about some of this work and to have us react and think about areas where we could potentially work together in the future. I think there's a lot of potential. So Mario, over to you, please.
Thanks. Thanks for that great introduction. I couldn't have reviewed it at that level of the work that you just did. So it's going to be I want to thank you for the invitation, obviously, both of you. I started my career at Ohio State, and all the econ students took the macro core theory with us, and they were some of the best students that we had. So I'm familiar with agricultural economics and some of the topic areas, but I'm particularly familiar with trained you are in applied micro and applications of DGSE and CGE and these tools and computation. And of course, you're doing a lot of the environment. A lot of other parts of your portfolio that I'm only vaguely familiar with, but I think I just want to kind of introduce myself to you and what I'm doing in terms of the span of topics. So this is not going to be kind of a standard seminar where I'm talking about one paper. I'm going to tell you, lay it all on the table here. Here's a bunch of topics. You might think I did a terrible job over here and this is pretty good. That's fine. And then, where do we go from here? A lot of the presentation is going to be at a pretty high aggregative level. I mean, I started in trade as an undergraduate studying an early Canada-US auto-pack trade agreement as an undergraduate thesis. And I remember, I think towards the end of that thesis, I wrote one potential downside of joining so tightly with our US counterpart is there are risks if something might go awry with our relationship. This is in 1985. So you wait long enough and eventually.
You're right.
But I went to Rochester and then the real business cycle DGSE stuff was just starting to roll. So I ended up doing that DGSE work in a highly aggregate way, but it was an open economy right off the bat. So I came back to that passion. So I'm going to talk about mostly historical work because that's where I've applied most of these trade models myself. Where we go from there to here, there's a lot of differences in the structure of economies today compared to then. But I want to convince you that tariffs can have macro effects, and how important they are depends on their breadth, obviously, but also what they hit in inputs and outputs, and also whether there's retaliation or not. So all these things I'm going to be talking about. And I'm also going to break away to a couple of other topics that don't get discussed maybe sufficiently. One is, technological diffusion that might be impaired by tariffs. And the auto diffusion of the 20th century is just a case study in that, I think. And then I'll also bring up some cases where sometimes in the US literature, even if there's a international focus of a tariff war, focus falls mostly on the US in the paper and in the discussion. Some of those tariffs in the interwar period just devastated other economies. Nobody's talking about them. So I'm going to talk about Cuba because that's an important case where the duties were so enormous and sugar so important that it was a really crucial role in Cuba, even more so than the US, obviously. So I want to get at a bunch of themes, but try to make it as coherent and seamless as possible.
Great.
Okay, so
That's perfect.
we'll go through these little bit. I gave a very high level of this at a finance center in a board meeting, so I'm going to add some more equations for you all, but I'm going to try and keep it high level and moving pretty fast. But interrupt with questions and comments every step along the way, because I don't have a lot of slides. I can get through. I framed that talk, and this is maybe an imperfect framing for this, but I do want to talk about restriction, the intent of tariff to maybe impair the entry of foreign competitors as a motive for tariff policy. And that typically is import competing products or firms or maybe entire sectors in some cases. I'm going to talk mostly about tariffs as the instrument. In the interwar period, it's a much less complicated environment for tariff study in the sense that tariff is almost the uniform instrument. Quotas are rare. Domestic content requirements almost non-existent. Regulation is there, but not a very regulated economy in many regards. So it's a little bit simpler. That said, the complex part is in the interwar period, and we're unpacking this now. Actually, not like earlier. We're unpacking like 4,000 lines of tariff code now. I'm going to show you my simulations where I had 3 sectors in 2 countries, general equilibrium. Now we're moving to 4,000 product lines because the tariffs are massively differentiated across products. And so I'm going back, we're going to be revisiting my work and saying, was that close to right or approximately right? And also, what's the cross-sectional impact, right? If the median tariff is 45%, but it ranges from 0 to 250, there's sectoral and income effects in the cross-section. We want to kind of get at that next too. So there's still stuff we're digging into. So we'll talk about, I want to tell you about the tariff history in the broadest possible sense as well, because I've worked on tariff history quite a bit. Obviously, there was a revenue motive that I want to emphasize. Obviously, Trump is talking about revenue, and clearly there's been revenue raised. If it's declared unconstitutional, that revenue has to go back. The deficit is only going to grow much higher, so that will shock the financial markets, I think.
Yeah.
So there's tariff revenue being collected. I'm not going to argue that it's the optimal way to raise revenue necessarily, but it's being raised. So I want to talk about that in the context of the interwar period, because in the interwar period, revenue for tariffs was a much higher fraction of federal financing. And I want to argue it was like 40% of total federal financing before the Income Tax Act was passed. The Income Tax Act was passed, it changed. I want to talk about that transition a little bit in the revenue part of the story. And of course, there's a cross section there, right? What things have lower elasticities that you can tax higher, and which things have higher elasticities that maybe can't tax. So I'm going to talk about Laffer curves in the middle part, right at the product level, and then aggregate those. That's this part. Reciprocity is a little bit miscued here. I'm going to talk about it in the sense more of how do your tariffs compare to your counterparts at the aggregate level or by sector, okay? And you can think about tariff escalating in terms of a symmetric tariff war, an asymmetric tariff war, or coming back down in terms of liberalization symmetrically or asymmetrically. And I'm not going to have a lot of foreign tariffs in the pictures here. I've got a lot of US detail, but I am going to show you a few international pictures from Trump 1 and Trump 2 distribution of tariffs across at least major trading partners of the US. So that's kind of the broad kind of framing, I guess. So history. So this is one of my favorite pictures. So this is the first 50 years of US tariff history through the lens of an aggregate tariff index. Now we all know there may be problems with that. If tariffs are prohibitive, this would be 0. So the whole distribution of tariffs matters for the index. This is basically average tariff, just taking customs revenue collected in the US divided by dutiable imports. Between a third and a little more than a third of goods travel duty-free fairly consistently. So obviously, if I use total imports, this would fall, but it would still be fairly volatile. So if you look at this first period of history, a couple of things I want to emphasize. One is the average here is about, 38 to 40%. Take an average unconditionally across this timeline. These vertical lines here are dates of legislative revision. So in this period of history, for the most part, Congress is deciding when to rise the tariff schedules. They're looking at this thousands of line tariff code and thinking about what lines to change, what to leave the same. And they have to be provided with a code book to remind themselves what they did last time in terms of connecting the lines over time, right? Because they don't, 7 years between a revision. So these are the lines of revision here. Everyone talks about Smoot-Hawley right here. That's this line. You see 1930, it was passed in the middle of 1930. So half that year was pre-Smoot-Hawley and the other half post-Smoot-Hawley tariffs. So if you draw a vertical line, you get to this point, which is about 52% ad valorem on dutiable goods on average. Now, it's sort of interesting. You see the peak here is 60. So if you read Harburger's skyscraper duties in Smoot-Hawley, he's actually pointing to this dot right here. Now you ask yourself, how did we go from 43, 44 to 60? Well, this is a paper I wrote in my dissertation. There's another part of tariffs that is a little bit obscure but incredibly important, and that is the use of specific duties as well as ad valorem. So you all know specific duties like 10 cents a pound, 15 cents a bushel, ad valorem is a percentage of the value. What's going on here? This was a liberalizing act, the Underwood Tariff Act in 1914. It was also a period in which the Income Tax Act was passed and became constitutional. So that's an important part of the revenue story. In this period here, what's happening principally is it wasn't the tariff revision that drove tariffs down so dramatically in this period. It was partly also World War I inflation. So think of a nominally sticky duties, 10 cents a bushel, and your price level is increasing by 60, 70%. For some commodities, by 100%. So that's driving the EVE down. So there's sort of a mechanism here where you talk about monetary macro, and it's directly here. And inflation generates a liberalization through the sticky legislative duty, okay? And that liberalizes trade here. Nobody talks about this tariff act here, the Emergency Tariff Act in 27 or 40 McCumber in 22. Those are massive changes in this line, right? Boom. You can see here, you sort of go back to the same level you had before World War I. So the obvious question to ask is, were we just resetting tariffs to their real index value that we had at the end of beginning of World War I? And that might be about right. We still have to look at the cross section. Okay, so that's like a reset. And then here, what's happening here? You all know in the Great Depression, deflation was significant, not as much as the inflation in the World War I. So deflation is like 30% in CPI. Again, commodities are going up by more, or down by more, excuse me. So that's causing an escalation of the tariffs. When the price level starts to reflate, you get the reverse happening. And then right here, you do get a genuine liberalization, which is significant. Here's where the president's getting involved, negotiating bilateral, reciprocal agreements with a number of countries. That takes a number of years to occur over major trading partners. And I think this was sort of a bit of the transition towards the GATT, where we just don't have bilateral agreements with the president. We have multilateral negotiations, right? So here we enter the GATT period. Pretty familiar with this. Notice here the starting point, it's a little deceptive, right? The starting point is here. So if I draw it on the same scale, this would be like down here, right? So I'm expanding the scale so you can see this. It's coming down here and then it's a big drop to the Tokyo round and away we go. You know, I studied some agreements in here in my thesis. So NAFTA is the one that's obviously in the news again, clearly. There's a little bit of this inflation thing going in, but nobody's really studied this. The inflation in the 70s is partly responsible for some of this decline, and there's papers being written by that now. Hasn't been looked at before, but principally these are multilateral negotiations that have been pretty much all one way, right? Tariffs have been declining at different rates, not like here, flat, down, up, down. So a lot more volatility. So the volatility is nice from a DGSE stochastic environment because the tariffs are changing quite a bit from period to period. And we have to think about forecasting those and thinking about where they're headed in our models. How persistent are they, for example? This is an important part of the analysis. Okay, so that's kind of the two histories here. Legislation, Congress, reciprocal, the president's involved, multilateral, that liberalization period. That's kind of a real broad brush history. Now, if we get into Trump 1, this is a nice diagram from a paper by Marion Meady and Redding and Weinstein. So here they're doing this is an AV over all imports, not, I wish they had put also the axis where the goods being taxed are listed with their AVEs, but these are pretty sizable tariffs, but they're hitting a small product set initially, like solar and washing machines, then steel and aluminum. And then it's becoming China, tariffing a lot of China goods here. So there's escalation through this period. Most of the literature I read is thinking about how much of these tariffs are passed through to final consumers. Some people say at the dock, it's like 100%. There's some debate now. My colleague Anson Soderberry is working on a paper now. That median parameter 1 pass-through is the median parameter. There's a distribution around that. Sometimes it's higher, sometimes it's lower. And then there's a paper by Alberto Cavallo of MIT, who will be here December 7th at a conference I'm organizing. He looks at retail prices where the pass-through is significantly less over the same episode. Okay, so we always want to be thinking about pass-through to the dock in terms of the tariff. In that terms of trade effect, does it exist? And I'll talk about Cuba, where there is a big terms of trade effect for the US. And then at the retail level, where obviously there's a lot of retail value added, which is going to be immune to the tariff, at least in a direct sense. Okay, so we have to be thinking about that downstream pass-through as well. This was hobbled together kind of quickly. I just took from the WITS in 2022, the shares of US trading partners, major trading partners, the effective rates in aggregate, and then some of these early announcements. Of course, all these things have changed multiple times at this point. So of course, Mexico, China, Canada are the 3 biggest trading partners. And, you can see the nominal tariffs are pretty universally below 5%. And then we go here and there's a major escalation. Now, when we think about this, what I'm not showing you here, you have to be careful, of course. India's average is 3%, agriculture is like 40. So, there are large tariffs on subsectors that are obscured by some of these aggregate numbers. We need to keep those in mind. So those should be part of your, if you will, negotiation or whatever else is going on, because agricultural duties probably don't help consumers in India very much if they're 40%. That's kind of the aggregate number. So we're back into an environment, and these are total AVs on all goods, right? Not just two. So we're into an environment where arguably the total AVE is comparable in some cases to the interwar period, because I was showing you just the dutiable set there. And the dutiable set is highly concentrated, believe it or not, in the US on sugar. If I take sugar out, it would drop noticeably, because sugar is like 20% of imports for the US and it's taxed upwards of 200% at one point in history. Okay, so these are big numbers, even from the perspective of the interwar period. Okay, the revenue. So here's our paper title. Interwar Laffer curve is not so funny. So that means sometimes, there's a joke about the supply side or saying the labor income tax is putting us to the downward sloping part of the Laffer curve. We can raise more revenue by cutting taxes. Most literature says for labor income tax, most countries are to the left. But for tariffs, that's not true, right? And it's sort of obvious why it shouldn't be true. If you have restriction for tariffs and revenue, you're trading off revenue and restriction. Restricting imports means low revenue. Getting revenue means not being so restricted. And that's going to be a nice environment to think about this trade-off. Congress wants to raise revenue from tariffs because it has to finance some of the federal government. It also wants to restrict certain imports. how does it trading that off at the product or aggregate level? That's what I want to get a little bit into next year. Okay. So this is where we're using, here's where we're using already the product level data. So in this part of the talk, this is a very disaggregated exercise that we've just started into recently. But I want to motivate it a little more broadly to step back for a minute. What would you expect to be happening in this historical period? So this dashed line up here, right here, is on this axis. This is the same axis, excuse me. Isn't that convenient? So this is the same axis for both lines. This dashed line is the share of federal revenue from the tariff. Okay, so this is telling you in the teens and 20s, about 45% of government revenue, sometimes upwards of 50%, came from the tariff revenue alone. Okay. Now the federal government was much smaller back in the day than today. State and local governments were a larger share of the public economics of provision of almost everything. So that has to be a qualification. But it's still a huge source of revenue. And they would sometimes talk about, well, we got all this customs revenue coming in. We don't need all of it for our expenditure. Let's give some money back. Okay, so this was a conscious debate at the aggregate level. Now, when the Income Tax Act comes in, which is a little earlier than this, sometimes there's a Revenue Act and a Tariff Act almost simultaneously. So there's a Revenue Act in February that passes the first official modern income tax. There was a Civil War income tax as well. I'm not going to get into that, but that was it constitutional or not? Da da da. This was what we would see modern income tax, 1913. It brings in that part of the tax. So what would you expect? Well, the import share, roughly 5% of GDP, but the labor income share is about 60% of GDP. So it looks like, well, you got a larger tax base. You can put a lower tax on a wider tax base and get more revenue. If you look here, there's a plummeting of this revenue number here to 1920. It's probably due to the tariff falling due to this inflation in part. So it looks like consistent with, I got a wider tax base, let's liberalize tariffs, right? And put more of the burden on labor income, which is a wider tax base, so a small income tax act. This income tax act had maybe 8% of the maybe 7% of the population. So it was quite progressive. It didn't start till like beyond median income. So that looks like, yeah, that's what we're doing. We're gonna, get all the revenue from labor income. Don't worry so much about the tariffs as a source. But then it kind of snaps back, right? So you would have expected from a public finance perspective alone, well, let's go with labor income tax, keep tariffs low and stay low forevermore. So the counterfactual you'd think would be tariffs would stay lower than this lower level, but they didn't. That's what makes these look very protectionist. You added an instrument to tax to raise revenue for another perspective, yet you still increased your tariff rates nonetheless going forward in the 20s and 30s. Okay, so that's the kind of the income tax perspective is you could have done something differently given this new revenue source. You chose more restriction. So these should be viewed as more restrictive, not just because they're higher, but because you've got income tax revenue coming in. Okay, just from a more equilibrium kind of a perspective.
Tomorrow, you would have a big expansion of total revenue, right? Because you brought in this, and that's part of the reason why the tariff revenue share of GDP, it's share of GDP.
So this is import share of GDP, so 5%.
But this one's,
55.
that's a share of total revenue, right? The bottom dashed.
This is, yeah. So,
Yeah. So as the income tax comes in, then the total revenue expands and the share of tariff drops.
It almost squares with these numbers,
Yeah.
but I want to be careful because we're not taxing the full 60% because it's a very progressive.
But yeah.
But we're
okay.
also not taxing all of imports.
Right.
So
Yeah.
it might be exactly, the math might work out precisely here, but then you obviously come back up again,
Yeah.
right? And that's the part.
Okay, yeah.
Does that make
But you don't
sense?
go all the way back up,
Yeah,
of course.
yeah. So let's dig into this a bit. So I mean, this is obviously there's a lot of product lines underlying that aggregate. So we're gonna work with we're gonna have log preferences at the good level and CES within each good in this exercise. We're gonna estimate elasticities at the good level. Okay, so these are varieties of imports across all source countries coming into the United States. Each good will have a different elasticity. We're going to keep the shares constant at sigma G with the Cobb-Douglas assumption. Later, we may nest CES on CES, but we haven't. So every good is going to have the same expenditure share in terms of imports, but we're going to substitute across sources depending on the tariff distribution. These are demand shocks. So we're going to allow there to be some taste shocks on the demand side at the variety level, just to add a little stochastic variation. There's also going to be a supply shock. We're going to have an export supply curve, which is just a reduced form where foreign supply rises with the price level. So we're moving away from the small open economy assumption there, not assuming the foreign price is fixed. We want to build that in as well. Okay. So the estimation technique here is based on Nance and Soderberry's prior work. And these AVEs are going to be, again, product level and by source. Okay, so the database is about 120 source countries and roughly 1,200 product lines. Most imports, a few countries supply most of the sourcing, but not many. Okay, so the equilibrium expenditure is given by this expression. And then we can think about the revenue. So this is the revenue the Treasury gets from variety J of good G. Okay, so we integrate over J and G, and we get total revenue. We normalize these because obviously, you know, you go into the Great Depression, the macro effect is going to draw the revenue down, but also there's, you know, there's other shocks besides tariffs driving the revenue. So the way we normalize this is we take the shocks, the G part, divide it by the left-hand side, and that's going to give you these terms here, which you can see are only dependent on the tariffs and the elasticities. The value of that is then the diagrams will show you moving actually along a Laffer curve as opposed to shifts in the Laffer curve as well as movement along. It's just easier to visualize the Laffer curve in this sense. Now, if I assumed a small open economy, infinitely elastic supply curve from abroad, and I would only get this first term here, right? So that would be standard. I'm moving the price along stable demand curve, and the elasticity of that demand curve is going to tell me how much revenue falls as the tariff increases. Okay, so an inelastic demand curve is going to have a fairly stable revenue, and an elastic curve less so. And that would be just governed by the good specific elasticity. This is allowing terms of trade effects. So there's a lot of debate. Does the US have any terms of trade power anywhere now, anywhere in the world, in any product space? Well, perhaps. There's going to be examples where it has dramatic terms of trade effect here, and others where it's less so. Okay, so we definitely want to be allowing. Okay, so any questions at least on this part of it? Okay. So I'll show you 4 pictures here. These are kind of aggregated up to sectors and the overall manufacturing sector. So here's agriculture, here's manufacturing, here's resources, and here's the US aggregate. What we're doing here is, so this red curve is tracing out, if you assume small open economy, that would be your Laffer curve. Okay, so that would be just dictated by the demand elasticities underlying the product set. Okay, so this is telling you your revenue maximizing tariff and resources in a weighted average expenditure sense would be maybe 20% thereabouts and so forth. Okay. These little dots here are tracing out as the tariffs change, right? I showed you those tariffs are moving a lot, right? They're rising through the 20s into 32, and then they're falling thereafter. So each of these dots is a given year as the tariff distribution changes by sector, by good, and so you can see.
Yeah, quick question. So you're estimating at the product line level, but the elasticities only vary at this aggregate level, or is this an aggregation?
This is aggregation. So the elasticities differ by good, and the shares of each good are constant given the Cobb-Douglas upper level assumption. So if you looked at good shares, the implication here is they'd be constant. Do we know that's the case? We haven't checked that yet. So that's probably not the best assumption at this point. So it's going to be the share of expenditure on good G will be constant given the Cobb-Douglas upper level. And then we're substituting across, varieties based on the different incidents of the tariffs. So you can see that there's 2 sectors where you go to the downward sloping of the curve. One is manufacturing, which occurs in the early 30s to 1933. That's when that peak in the tariff tended to occur. And in agriculture, you see that's happening much earlier. And obviously the tariffs are much more escalated there, right? So you're definitely on the downward sloping part of the overall Laffer curve. If you had done this partial equilibrium small open economy analysis, you would have been much farther down the downward sloping and lost much more revenue. So the export supply elasticity is giving you more revenue. That's the terms of trade effect kicking in here. It helps to raise. Some of the burden falls on the foreign supplier. Now I told you sugar was an important part of agriculture. Well, the next picture is going to show you just how important, I guess. So sugar was about 20% of total duties in the US. Like that's one, we're talking about cane sugar, right? Talking about refined and other sugars, so this is a huge import, despite the fact that it was highly tariffed, because the alternative was if you talk about inefficiency, beets, sugar beets, very inefficient source of sucrose, right? So the tariffs have to be at least probably more than 100% to start to energize the sugar beet industry, basically. And you see that in terms of beet imports. There's a tiny little bit, 80% tariff from other sources. So cane sugar, sucrose is practically dripping out of those stocks. Beets is a much dirtier, more expensive proposition. So the tariffs put on here to protect the beet sugar industry. It's a classic kind of protectionist argument. And Reed, who's one of the co-authors of the Smoot-Hawley tariff, his brother happened to be vice president of the Utah Beet Sugar Refining Company. That might have had something to do with it. So you can see here, these are not raising you any more revenue. You're basically on a very flat part. You'd be downward sloping on the demand part, but with the supply response, you're basically raising no more revenue. So that's clearly restrictive all the way forward as you go to the right. And when I bring Cuba into the picture in terms of business cycle analysis, you'll see how devastating that was for Cuba. So any questions on that? So revenue, a lot of revenue raised, differentiated across products. Clearly, some products and sectors were restrictive, so not revenue maximizing. That's where the protectionist part of the intent comes in. We're going to try to build that model to trade off these revenue and protectionist motives. We haven't got that built into the model yet, but that's where we're headed with the political economy part of the story for the end. Questions? Okay. So we're going to change gears and go to macro. I'm going to emphasize the first two channels. The third one, I haven't got models that are sophisticated enough to embed monetary policy and fiscal policy in the interwar period. Those have been discussed separately in the literature. So I'm going to talk about what I call supply side efficiency effects and demand substitution effects. And in a lot of models in practice today, in both macro and trade, those can be convoluted, right? If you don't have an intermediate input sector, obviously your prices can rise or fall based on the efficiency distortions or the final goods actually being taxed. And we really want to unpack those in the model. I'm going to show you how we unpack them, and there's different ways to do that. Okay, so I want to think about supply side efficiency effects as basically I have intermediate inputs, so I'm treating domestic intermediates different than foreign intermediates, and there's a substitution towards an inefficient supply. That's going to affect whatever downstream industries use those intermediates. In my model, I only have one intermediate for the US and one foreign intermediate in a two-country world. I've got a CES substitution over those two intermediates, and then that has a fixed coefficient. We start off with Leontief coefficients, and then we relax that assumption later. I'm going to show you the Leontief case because the math works out just real beautifully in terms of an analogy between taxes on inputs and value-added taxes, and you'll see that mathematical isomorphism is perfect, and it's beautiful to look at. And in some cases, it might not be too far from the truth if some goods are not substitutable in terms of intermediate. We can think of cases where that would be true. Okay, so I'm giving you a model and one big swath of equations here, but basically we had in this model, it's a very aggregated model. We have a non-traded good, C1. We have a US export good 2, and we have a US import good 3. No varieties, nothing, just very aggregated model. Labor leisure choice. Here's a CS aggregator for those. Total time allocation is just assumed to sum to 1. So we've got labor moving across sectors frictionlessly here. Then materials, here's the value added function, Cobb-Douglas. And then we're going to have materials being, in the case, I'll show you Leontief with value added. Okay. But the materials can be substituted. Here's home materials used in home production. Here's foreign materials used in home production. That's your materials aggregator for the US. And there's a foreign counterpart, obviously. This non-traded good, the way we model it is the non-traded good is also the capital accumulation good. We can do different things there. So non-traded means investment in durables consumption. And the traded goods we're treating as perishable entirely.
So services, I don't
Well, services I would put in here, but I wouldn't want them to be durable necessarily. So I'm a big fan of retail and distribution sectors in my more recent work. So ideally, you'd probably want to have a service sector, the retail and distribution sector that's the wedge between traded goods and final goods. So those two things are really in this. The non-tradability of this is embedded here, but this is an investment good. So to be a little careful about that interpretation. I'd rather have just got a model of the Great Depression running where services are literally non-perishable and they're just financial services, retail services, whatever services. That's a crucial sector, obviously.
Just for,
Yes.
looks a lot like the 1, 2, 3 model. First model.
1, 2, 3 model. That's what I'm
Yeah.
going to call it from.
Yeah. It's
1, 2, 3.
not exactly because, yeah, exactly. It's.
Wait a minute.
Yeah, there's a 4. Yeah, no, that's right. It's got other detail in there, but the setup is quite.
Advanced version.
It's more advanced version.
4.
Yeah. 1, 2, 3, 4 model.
Doesn't mean it's 50% better.
A third better.
20%. Do the math. Okay. Okay. So, there's, we actually, so we log linearize this and solve it to a first order log approximation. So we're not solving the full global nonlinear model. But I want to make this isomorphism. There's this paper by Chari, Keough, McGrath, and Econometrica kind of cast the one sector model in terms of all the things it would incorporate in terms of what taxes and other wedges might represent. And one example they have in there is intermediate inputs, and it follows very closely from what we're doing here. And when I was asked to revisit the Great Depression paper in 96 and 2007, instead of just republishing that in the volume, I said, we're going to do the Chari, Keough, McGrath thing. We're going to say, let's suppose you had a trade model and you had tariffs. Let's suppose you had a one sector model and you had productivity shock. I'm going to compare these two things. And we're going to do it literally mathematically as an isomorphism through the order. So we've got an intermediate input share here in terms of profit function. So this is the price of materials in terms of that composite to foreign and domestic materials. Obviously the tariffs impinging that, and there's a cost share theta. Right out the first order conditions, 1 minus theta, price of materials, value marginal product to capital, labor, value marginal product to capital. Neoclassical model, of course, you're going to get productivity, value marginal labor, productivity, value marginal product of capital. So if we set this to this and this to this, I can run my one sector macro business cycle model and tell you what the productivity path would have to be in that model, total factor productivity, emulate what the tariff is doing in this trade. So that's kind of the fun part of that, going back and forth. Because I think you talk to one audience, tariffs and distortions across sectors, and inputs, but the macro, talking about productivity so frequently, it's good to have that mapping as directly as possible. And of course, every model has a slightly different mapping, but I think the intermediates, certainly if they're going to Leontief, you can integrate them out, but if not, you can function here that pulls them out, depending on how granular you want to get about the distribution of intermediates. But here it's pretty simple, okay? The other wedge, and I'll show you a couple things about if you're doing a small open economy, then this productivity is just basically going to be a function of the tariff, because there's going to be no foreign price response to your tariff by assumption. It's just going to be treated as exogenous. You can work through the math of that very easily. If you have the GE version, then you got to think about how substitutable domestic and foreign materials are, because in general equilibrium, that's going to affect how much you impact the price of materials abroad, given your tariff. Okay, so that's, you can see here, it's the tariff enters with the aggregator function. That's the counterpart to this one. Okay, so G is very different than partial equilibrium. That shouldn't be a surprise to anyone in the room. You're going to get a much larger effect here. I mean, basically the math of this is very much like, well, if you got an infinitely elastic supply curve, a demand shift is going to give you a larger expansion or contraction. That plays out in every part of a GE model. So assuming price is fixed, it's basically assuming a lot of elasticities are infinite. That gives you a bigger bang for the buck, so forth, for tariffs, for productivity, for anything. Same thing with the productivity shock. Canada small open, bigger effect than in the US large open, for example. Okay. All right, so this is just kind of restating a bit of that. In the interwar period, I didn't tell you that much about this. Which time do I go to? Sorry.
Why don't we go to 12:30 for your talk, then we have time for discussion.
Okay. So both the home and foreign country are large. By that I mean, in our context, the foreign country is all US trading partners aggregated into the rest of the world. And that's close to a symmetric geography. You know, the US is not quite half of the world, but it's close to half when the world consists of Europe, Australia, some South American countries. So it's almost symmetric in size. And the tariffs aren't exactly symmetric, but we ran a symmetric case because then the analogy to the one sector model is a little tighter, obviously, as you might expect. Okay, so symmetric tariff war, two large countries. I'm going to show you the result for that. It's not too different from what we get in the more nuanced case in our JME paper. Okay, so basically, you know, if you put a tariff on unilaterally, you're going to affect your terms of trade. That's going to have less of an effect. If you have a symmetric tariff war, both countries tariff, you're going to move the production possibility curve in for both countries and symmetrically the way you've written the model down, right? So each country's PPF moves in, the world PPF moves in. It's really bad for everybody in the symmetric tariff war case. Oops, that's mine. I brought my own presenter. Okay, so here's our simulation of the tariff escalation from 29 to 33. Remember, it went from about 35 to 60%. Okay, so here's the model, and here's the US data on this axis. Now, careful. This axis is the actual Great Depression. This is minus 30, and this is minus 1.5. So what did we say? 5%, something like that? No, not 5%, is that right? 2%, is it 2%? So I had this, Lucas and I used to have this debate when we would converse, and he was, why are you bothering studying terrorists? We know given the trade show it would be trivial. I thought it would be about maybe like this. So this, remember, would be like a post-war business cycle recession. As in every post-war business cycle recession, the business cycle economists have studied since then. So we never thought it would explain the Great Depression, but that's a big effect for a macro impact of tariffs, right? 1.5% of GDP peak to trough. And then of course it recovers quickly because remember that tariff line, it falls off almost as dramatically as it rose because there's this escalation and it comes back down again. So that's why we get this recovery here. The economy doesn't follow the tariff like one for one because there's capital accumulation, obviously labor supply and demand movements, but it does kind of correlate with the profile of the tariff sequence, okay? If we had put a transitory tariff in here, and we do some experiments in the paper, you get a very small effect because basically the capital accumulation effects are not going to start to hinge. Another way to put that is if you have a permanent tariff, you move to a new steady state, which is lower output, right? So if it was permanent, we'd go down and stay down here somewhere indefinitely. But because the tariffs come back up, the question is how persistent are they? And if they're persistent enough, you're going to decumulate capital as those efficiency effects work their way through the capital stock. If you wrote down a static model with only labor, you wouldn't get the capital accumulation effects. We show those are large. If you write down a model with no labor leisure decision, you get a smaller effect as well. Okay, so both of those things are working. And the intermediate inputs are the biggest part of this whole story. And that's what I see over here, because the way we're doing the efficiency wedge, remember, is this intermediate inputs hitting the value added function. And what we call the labor wedge here is basically the consumption price index rises with final good tariffs. That reduces your purchasing power. That looks like a wedge between consumption and labor in the neoclassical model. That's what the labor wedge is in Char-Cubic-Grad. So just think of that as how much is your expenditure function affected by the tariff distribution after your optimal responses. But here it's also affecting a bit the labor consumption margin but you can see it's a small part. That's the final good tariff labor wage part. This is the intermediate input contribution. Okay, so it's the lion's share. It's about 1% of the total. Out of about 1.2%. Okay, so S&G wedge is important.
Lucas was thinking about the labor wedge only, is that right? Or in your,
No, Lucas was just thinking about, doing the Holton's theorem sort of, the share of something tells you
Yeah,
roughly
yeah,
the effect you're gonna have. And if you have a 5% share affected,
Mhm.
right, obviously you have to think about substitution ability, right? So, my rejoinder was usually, well, oxygen is only 1% of what's in the room, but if we eliminate all the oxygen, so that's a substitution statement, right? So if you can substitute, okay, but if they're essential inputs, not so okay, right? So we have, essential inputs here because they're not very substitutable. That also brings the effect up, but the share still disciplines that. And if the share of inputs is here like 50%, which is out of the input output tables, if the traded share of inputs were much higher, you get a much larger effect here, right? But with a 5% trade share, most of the intermediates are still sourced domestically. Sugar would be a counterexample, where it's more like half and half. So obviously, when you come to modern dates, you got to think about, how do you recalibrate this with the tariff distribution inputs and outputs? Where are substitutions possible or not? So we agree, Lucas and I probably agree on the size relative to depression, but we disagree on whether the exercise is worth conducting or not, I guess is what I would say. This is sort of interesting to me, and I'm going to admit right away, I haven't yet looked at the Yale policy model for today. This is my simulation of the Great Depression in 1996, first version, did it? So -1.5. -1. Coming back up here. So in the way they present the paper, the only thing they talk about in that presentation is if you assume consumption behavior doesn't adjust to the tariff distribution, you get a bigger effect than if you substitute across consumption goods. I don't know what the supply side is behind their model, and I've got to communicate with them and figure out what's going on. One thing that could be happening, because you notice here, this is like it looks like the end of the Trump administration. This is what it looks like to me. The end of the Trump administration, we're going back to something, but it's not the old normal, it's a new normal. Maybe, I don't know. I got to ask. There's a permanent effect here. That's like -0.4, which is, not quite half of the short run depth. But I just thought this was quite interesting that these things map numerically in terms of that contraction phase. I would think if I ran what I was doing with intermediate inputs and stuff, it would be bigger. So I'm wondering if they're actually modeling intermediate inputs or not. So that's something I'm going to have a conversation when I get the opportunity. But just to know, there are other exercises that are going on, some in real time, like updating every month, right? Some papers. We'll have a paper presented here on December 2nd also. We're forthcoming in the GIE where they're running every time the Trump changes the tariffs, they run a new simulation. They're using an Edom Corridum type model. How fast factors move across sectors and location and those things. This is a very difficult exercise to do, even when you have a lot of time to do it. Spent 35 years, I still don't know the answer, but I'm getting closer. Okay, so that's interesting. Today versus then in terms of a macro picture. That looks curiously similar. I'm going to talk about two. I'm going to change gears and try to hit two other points in the next 10 minutes. This one I think is more in many ways could be more important than the aggregate picture. So what's going on here? Here's a picture, a nice graphic. So here's a May Day parade in New York City. In this picture, which is in 1900, it's kind of blurry. That's on purpose, so you couldn't see the cars. Well, mainly these are horses and buggies, right? 1913, it's kind of flipped mainly to mostly Model Ts, okay? So this product diffusion from one transportation mode to another, the diffusion of the automobile, it's an important part of early US history. And there's been some narratives about it in economic history literature, but no one's really tried to quantify that diffusion, how it took place in the US or abroad. So we're going to look at this in the US, but principally you want to see, well, what happened in the rest of the world? Now here's a key part of this. the nominal price fell by about 62% in 13 years. And if you look at like the peak to trough relative price, it's like a factor of 3 decline, like $1,500 for an average car in 1913 down to less than 500 by 1924. And a huge part of that is Ford Company assembly line, driving down the cost of cars, and also making the car affordable for the average consumer, unlike the European market, which was tended to be high priced, more custom, not so much mass produced. Later on, that changes. So that's another part. Just some, why did I get that away from me? So here's the price. So this blue line is the US price, just an average price per car. They're fairly homogeneous. I don't feel terrible about doing that. You can see the massive decline here. Then later on, the relative price just folds into distribution. You wouldn't know the car from an apple, banana, and orange in a sense. Relative price is just kind of flat. So that's the price decline. These are export unit values across like 100 I guess this is probably 23 destinations. We have 100 altogether. So the median export unit value is here. So there's an export markup. Things got kind of crazy during World War I. There's lots of stuff going on. But maybe it's like a 20% markup. So we're gonna say, prices are correlated both in the US and abroad. So we've clearly passed through those prices to foreign destinations. Here's the quantity picture. Here's the US, 120, 125, 130 cars per 1,000 people. Sounds little, but that was high for the day. The median in the rest of the world is 4. All right. And even in countries that produce cars, it wasn't anywhere near the United States. Like maybe Canada, Australia, and the UK might be around 80. Okay. So why this and why this? We're trying to explain a 40-to-1 diffusion gap in a product that seems like, why is it? Well, here's what we do. We put a bunch of wedges in. Fuel tax. That's kind of a bit non-standard. There's huge gas taxes. They're like 200-300% in some countries. So the user cost of a durable is an important factor, and if it's taxed, differential. Retail distribution, customs duties, shipping costs, destination markups. I'm showing you some of the cross-section, not the full cross-section. Then we do a bunch of counterfactuals after we estimate price elasticity and income elasticity. If we eliminate all those wedges, we can explain about 2/3 of the adoption gap between the US and the median country. And the biggest contributor is actually the fuel tax. I thought it was going to be tariffs. Obviously, those are big here, 45%, some are 60%, but the fuel tax is really crucial. Okay, so car didn't diffuse because there were high taxes of use, there were tariffs, and obviously later on in history, Europe's still lower than the US in adoption, but it's much closer than the rest of the world is not at 4 per 1,000 compared to 120. So these wedges were really important. And that's a lot of wedges we had to construct for this exercise to be complete here. And this retail distribution wedge is a big wedge now, right? And that differs across countries. When you go to a poor country, the retail distribution wedge is lower because the cost of providing retail distribution is less relative to you, right? And for them as well.
Were these, so you're inferring their domestic price from?
We're building it up. We have some observations on the foreign prices. We're building it up from the US price based on the wedges that we.
Very quick question. I was wondering about cost of domestic services to support your essentially to service a car. Yeah.
That's what we want to do. If I did that for the world, I would retire with that project. Basically, I think that's how long it might take. So we're going to do it for the US because the US data is much more readily available. So we've got a project where you've got cross-state variation in diffusion of the car, and it's highly correlated, but it's differentiated. And there we can get number of gas stations as they evolve, roadways, miles. So we want to build in all the complementary inputs that we didn't have in this project, because obviously there's a dynamic feedback loop, right? You adopt more cars, more infrastructure is built, that feeds back into the value of a car and so forth. So I think we can make progress on that for the United States. I think that is crucially important. So that would kind of be, that's in our residual here, why we can't, or we're picking it up some other way. That's crucially important. A lot of people say, well, Europe, they have cities, why do they need cars? Well, they have a lot more cars than they did then. So that delayed development in automobiles, I think, is partly due to this part of history. Okay, so Cuba, I promised you I'd get back to that. Cuba, whoops. Here's Cuban GDP, here's US GDP. So the two suffered a similar Great Depression trough in terms of peak to trough. Let's say 30% for the sake of argument. I want to convince you that it's not like US, it goes into a deep recession, they don't eat sugar anymore. That's the export, right? So there is luckily a downward slope of sugar consumption, so that's probably a good thing, right? Less sugar in the diet, but it's much more gentle than this trough, right? So there's a genuine change in the ratio of sugar to GDP. Sugar is relatively inelastic in demand. We saw that in the Laffer curve as well. Well, I can there's a terms of trade effect. How am I going to do that? Well, here are three prices. There's the Cuban price, Cuba plus tariff, the Philippines price, and beets. So think beets price, basically the US landed price of sugar. Philippines is a duty-free source, doesn't have an infinite supply. You can see that these are all pretty correlated. The Cuban price before tariff is like falling almost 1-for-1 with the tariff increase. So you can see there's a terms of trade goes, terms of trade falls by a factor of 100% between here and here in terms of Cuba's export value. So that's the mechanism. And this is just a simple, small open economy DGSE model, nothing too sophisticated. I export sugar, I import everything else. Pretty abstract, but it gets you a Great Depression just with the tariff. Why? Because the tariff is hitting, 2/3 of value added. So it's like, it's if you go back to that value added tax again, it's like you're taxing most of labor income at a rate that goes from, 50% to 200%. How do you escape this? Well, Cuba could, sell to other markets or so forth, or change its nature of production. Changing nature of production is not something that was easy to do. And every other country tariffed sugar as well, because they had Europe had beet industry just like the US. So that wasn't a trade diversion option. So it was devastating for the Cuban economy, these US sugar tariffs. Obviously, it cost US sugar consumers a couple of percent in terms of refined sugar as well. And we can show you that domestic beet producers in the US gained a little bit, but the primary losers were Cuba by far. Okay, so that's it. So that's the summary. So a whirlwind tour through a few topics there. So questions, comments, how do we think about today versus then, whatever, any other things you want to chat in the next little
First of
while?
all, a hand for a simple presentation, taking us through all of that work. That seemed highly relevant for today. Questions from the audience? Could you say a little more about the prospects for integrating the DSGE work now? How close are they getting to the kind of detail we would be thinking of in terms of the GTAP modeling work? What scope for bridging those two areas of research?
Well, maybe it can be scaled up dramatically. The question is whether you want to use, we're using log linear approximations. There's global methods now we can use, like neural networks, and we're learning about these in computational classes now in terms of scaling up some of these decision rules, solution methods. So it's feasible to get
Computational issue. It
could be. It also depends on how you model the granularity, right? So if you can aggregate the tariffs to a more sectoral representation, then you don't have to worry so much about the distribution across line items. Like if a steel tariff hits, a certain band of the production sector, just aggregate over that production sector based on its incidence. So you don't necessarily have to disaggregate too greatly. It's going to depend on, in some sense, Trump made it a little easier in the sense that a lot of the tariffs are uniform, not entirely, more uniform across products, more differentiated across countries, not exclusively. So that helps a lot. Because here, when we're doing this, we have to go from 4,000 lines to an incidence. I did that in a red paper with Rick Bond and Joel Rodrigue. It was partial equilibrium. We just aggregated the tariff lines to the 40 sector input output table. And then asked what would be the aggregate efficiency effects of that distribution of tariffs from 4,000 lines into 40 sectors, given the input output tables. The answer was surprisingly close to that peak to trough calculation in the aggregate model. That might have been divine coincidence, or it might be that.
Were you doing ESG modeling at the 40 sector level?
This was just steady, this was
Calculations.
steady state to
Okay.
steady
Yeah,
state.
Yeah.
You know, in some sense, you know, in a small economy, sometimes you get a bang, bang result. You could go right to the next steady state if you allow, you know, borrowing and lending. So it's like, to get the transitional dynamics, you usually have to assume some, you know, quasi-fixed factors to prolong the adjustment. Like if you had just consumption tariffs, right? And I ran those tariffs through, you would be basically the incidence of the tariffs would just dynamically evolve based on the tariff distribution. That would be very mechanical. So if you don't have a state variable like capital, right, that's inertial, and you have to think about its current and future value, then it's more like a static repeated equilibrium. And for consumption tariffs, that can be done much more mechanically. But
Should
again,
we maybe first be looking to the DSGE world for steady state calculations?
I would say the opposite. I think this is more useful in terms of changes, time derivatives, business cycles,
Yeah.
transitions to a steady state. Because you have to remember, if we do a business cycle decomposition for almost any country, right? If you look at the supply side versus the demand side, okay, the demand side, we know consumption is usually, you know, consumption is usually the big factor, not as big as its share because it's more stable than investment. Investment is the biggest contributor to business cycle variation of business cycle frequencies. Why? Its share is 20%, but it's like 4 or 5 times more volatile than consumption. That means if you don't have investment in your model, you can't square your DGSE model with the NIPA counts. Because one of the big parts of it, aggregate demand, is missing from the model, right? So you know you're going to have trouble there. And that's where the capital accumulation comes in and the durable goods part. So the durable goods come in here because if I have a durable goods stock, right, I can consume the service flow from the durables without restocking for the length of the life of the durable. So if the tariffs are very temporary or not so permanent, the durable goods piece allows me to have very small welfare effect of the tariffs. Perishable goods they bear the incidence in real time because they have to be restocked every period. So durability on the consumption side and non-durability, you saw it for the automobiles as well. Durability and non-durability on the consumption aggregator side and capital accumulation on the supply side are the key parts to getting the dynamics right.
Are you modeling the important role of an investment?
Well, our investment, remember, our investment is produced with the same intermediates as consumption. So everything's produced with the same intermediate
So that's a
structure.
huge,
You could
I
break,
mean,
you could break that up.
that is a huge difference when you look at the data. I mean, intermediates, investment much more intensive in the intermediates.
Maybe, I don't know. I mean, some of our intermediates are the same, like the notebook computers and the desktops. Those are almost isomorphic between firms and consumers. Cars and transportation equipment. So there are probably exceptions, but I think.
I'm thinking of probably calculations done 20 or 30 years ago, so I'm probably out of date on that, but. Yeah, just to digress for a minute, there are people out there in our network who are very interested in the 4,000 or the 5,000 tariff lines, HS6 calculations. Badri is doing work with the Saudi government, for example, as a version of GTAP where it's a GEPE formulation. There's a nested PE problem within the GE framework. So he's not modeling the full intermediate input output structure at that level. It's a kind of a transformation frontier within the sector across those many products, and then on the consumption side, substitution across the many products. But you do get the tariff line competition, which is really important for some of these countries, and but that's kind of becoming a routine process within the GTAP community. You're running the GTAP model, but you've got tariff line competition, which is really important for the policy folks.
Think about where you want symmetry and convexity and where you want to restrict that. So when I think about, durables and non-durables is an obvious one, right? Where if something is durable, right, a temporary shock is not going to have as large effect as a perishable. That's just a stock flow result that you can, in almost any model that's true. The other one you can think about the old, maybe I don't know if you should remember the old Cambridge debate. That was a little bit Leontief approach versus neoclassical macroeconomics. So in what places of the production function is there high substitutability, so you can convexify away any shock or any tariff pretty easily by substituting in the factor inputs? And in what cases are those substitutions almost impossible, right? So, steel tariffs are different than tariffing a product within a set of varieties, right? If you tariff wine, we can substitute to Californian wine. We might not like the result, but it's not too bad. But if we're tariffing steel, so pull out the areas where that substitution possibility on the production side isn't possible. I'm always in the back of my mind, I was thinking the production side substitutabilities are typically less than the demand side consumer substitute.
Yes.
You go back to Lancaster's view of preferences, like we have certain basic needs and we have almost an infinite number of ways to satisfy them. That's not true of the production side. Right? There are technological relationships that are just inescapable in terms of the physics. We need steel here, we need aluminum there, we need plastics there. So think about organizing the inputs in terms of that.
Yeah. So you're kind of painting a picture, in my mind, you're kind of painting a picture saying, okay, here's some aggregate model, PSGE model. And we want to capture the key elements there, this transitory path so we need to rethink the way we're aggregating. We aggregate in kind of obvious ways, but you're saying we need to rethink our aggregation more along the lines of these economic components, substitutability, durability, those things.
Because that elasticity between domestic and foreign materials obviously hinges on what are in those two aggregates, right? So if you take a very aggregated approach like we did there, you could easily conflate consumption substitution with production substitution. Because effectively you're making a certain set of goods more expensive in terms if they're more intense in foreign intermediates than domestic ingredients. That could be the substitution over here. See what I mean? But if you take steel, right, follow steel to its ultimate conclusion, what objects are going to be affected by a steel tariff directly and what objects are not? That's a way to parse the elasticity. So aggregating not just where the tariff incidence is, but also, right, where the substitutions are lower. Because you can't substitute away from the incidence. So it's a little bit, I can't give you an ironclad rule. It's a little bit context specific depending on the incidence of the tax or the tariff. But primary inputs are primary inputs. So I think raw materials, when I put energy in the neoclassical production function, why did I choose that as opposed to some other thing? Well, I thought it was the most obvious thing missing from the F equals, Y equals F of K and N. No energy, no production. Think about oil prices, highly volatile.
Maxime, this relates to your work on critical minerals. That's why they're interested in critical minerals. So you can think of a DSG model where in some sense critical minerals were critical and played this key role.
And the other thing is, I tend to think general equilibrium tells us something about where to look for that. So if you see a price that's enormously volatile, that's a sign that there's some non-substitution going on.
Yeah, that's a good point.
So commodities all fall into that category for a reason, right? If wheat, what can we substitute for wheat? Steel, aluminum, oil. Even in the medium term or long run, right? But certainly in the short run. So prices can help.
One tricky point with critical minerals, especially in the long run, is this role of technology, right? Because we do observe some types of, let's say, batteries produced with specific mix of inputs, but the question is, whether in 3 or 5 years it would be a completely
They're moving so
technology,
fast,
right? Yeah. And then if you bake in those assumptions in your model,
Then
you
you're
might end up with, you know,
way more.
right.
impact.
You might overestimate everything.
Maybe you
substantially.
trust the long run forecast of your model better than. So I think, look at a shorter term horizon, right? And then you could maybe put a probability distribution around the innovations. I mean, even when we had Lars Hampton, he's starting to get into the climate change stuff and, there's innovation that could reduce our energy demand through, some very improbable innovation. That's a small probability event that's very impactful. But there's lots of other things that are kind of near term, more forecastable. One would think as unforecastable as the Trump tariffs are, can you put a probability distribution over that that's easier than an innovation that will completely transform our energy needs? I guess that would be the question. And also the question would be, what would be the unit cost per BTU, right? Even if that transition occurs, the only thing you're going to be feeding into your model, presumably, is the cost per unit of production. So is it going to transfer, is it going to change the nature of production and the structure of production also, or just the cost of energy per unit? Because if it's the latter, that's a little more manageable, right? Because then you have to kind of try. And the question is, what innovations, how do you map innovations into that space? Energy requirements per unit, BTU. I don't know what that distributes. That's an important question to ask.
Yeah, I mean, partly it also gets to the aspect of like geographical distribution of impacts, right? Because if you know that DR Congo is mining a specific mineral, and then if that mineral there is a high probability would be fully substituted, right? That's a very country-specific question.
Diffusion
Right?
literature.
Yeah.
I mean, I've read the diffusion literature, part of my graduate course now. Diffusion, why is it puzzling? An obvious dominating product or technology takes a long time to adopt, right? We need to understand that. And we talked about the complementary inputs. That's one part of it. Like there was one person who imported a car in Brazil. I think it was the president at the time. He also imported a mechanic. So that just, that's sort of the storytelling. But if you don't have the inputs, you might well be importing something that's useless because you can't fix it. So those, that and the production structure is kind of the other side of that. I don't know the answer to that question, how much the production structure changes and respond to different energy, but maybe we could look historically and learn something about that.
I have a different question, but I think, Max, the critical minerals part is a little bit different because, like cobalt or whatever it is, it's a really small cost share, right? It's just physically necessary, right? And it does substitute, there's other ways to do it. So, it's having some property that's really necessary for some of the physics that's going inside a wind generator or something like that.
I think it's fair to ask whether rare minerals, including lithium, is the next geopolitical area that oil has been over most of.
Yeah.
Right? So I think, these rare resources are not uniformly distributed across the world. This is something we need to be thinking about.
Yeah, that's right. And that's where he's going.
Yeah.
Yeah, so I think we're on the same page. I wanted to ask you just about you've looked at the Great Depression, and there's a lot of this is on the real side, but what about the terms of trade side and price effects and what have
Well,
you?
Cuba was dramatic, right?
Dramatic,
It's going to Cuba, right? Where there's clearly there's an ability to substitute to another product set, very dependent on the United States, massive terms of trade power. And there are other examples we haven't kind of worked through. I did the Cuba example because it was so obvious as a macro effect.
Right.
But there are other cases where there would be terms of trade power, certainly. I mean, this is a point in which the U.S., the U.S. is like an energy Goliath, and then it becomes a manufacturer. It's actually terms of trade favor agriculture relative to manufacturing in the late 1800s, and then becomes a manufacturing leader after World War I because it's providing a lot of those munitions and developing more manufacturing capacity. But there are terms of trade effects in there. What are they today? I don't know. I've seen papers written 15 years ago that claim that the U.S. had no terms of trade power on any sector. I don't know if I believe
Right,
that.
there's a whole slew of papers out coming out of the NBER now on terms of trade effects and, on what conditions are they there and when they're not and so forth, yeah.
Guitar, you have a question?
Yeah, thank you for the presentation. I'm very interested in how can we model the foreign direct investment in this context? Because when the tariff is volatile, firms might think about having production site inside the country where the import tariff is volatile. Can we model such a dynamics in this setting in the context of tariff?
Yeah, you can. So there's two ways to think about this. One is to have, a probability distribution where you go to high and low tariff regimes. And obviously, I mean, Ford had already set up some plants in Europe. Sometimes he was allowed to serve, to get some of the inputs free within the European area. So he was jumping the tariff wall in the 30s already because the tariffs went up. Actually, I put a Markov distribution on the tariffs, and you're going to want to have plants that span geography so you can move capacity to the home country if you can't serve it from the domestic shores. If you think about nominal exchange rate variability has been with us since Bretton Woods broke up. Nominal exchange rate variability is not perfectly hedged, right? So one of the reasons companies have multiple sources and plants in different countries is also to hedge that input and output cost risk and demand risk from exchange rate variability. I think, and I don't know if, how much of our sprawling supply chain network is due to exchange rate risk. Some of it might be. Some of it might be playing off one national union against another. There's lots of reasons besides efficiency. This is important, right? Why is the supply chain so fragmented between the US and Canada? These are two countries at similar technological levels. We're round tripping a car 4 times. It's not obvious that that's all due to specialization in its purest sense. Some of it might be exchange rate, some might be, labor bargaining orders for labor unions. Some of it might be transfer pricing. There's a lot of different motives for having that ability to avoid a national power imposing its policies on you exclusively. So bridging the border, there's lots of motives for that. The tariff's a good one, I think, especially now, I think. And there, the duration, are you going to make a $4 billion investment if the tariff's going to last 2 months? Probably not. So there, the duration is important. That gestation, when I talk about capital being persistent, there's a time to build aspect of it. So the option value of a plant, if the tariff goes back to 0, is the anticipation the tariff might go back up to 50%. What's the probability of that? Now, you could also ask yourself, many of us said, well, when Biden comes in, all the tariffs are going to go away. Well, they didn't. Why? Because they're generating revenue. That's why I talked about revenue.
Right.
Once you have revenue, in some sense, from a political economy perspective, even if it's an inefficient source, and that has to be fully vetted in terms of other tax instruments, you might be reluctant to move back away from it. That makes it more persistent. And then your model would have a different implication. Yeah, let's build a plant. Sri Lanka's just moved from big plant from Canada to the US recently. I went to the Bank of Canada conference a couple of weeks ago. So I've never been to a monetary conference.
You're Canadian, by the
I'm
way,
Canadian,
just in
sorry.
case.
Yeah. Well, actually, I worked there as an RA in like 84, so it was a home company. So I was discussing a paper, and it was ECB Bank of Canada joint. And it's the only time I've been to a central bank conference where half to 2/3 of the program is about tariffs. And that's telling you, the asymmetry, the effect on Canada is much larger than the effect on the United States.
Yeah, absolutely.
That was true historically, it's certainly true today. And there's a representative from the entire aluminum and steel industry on a panel. That industry was represented on the stage because they're really being hammered by these tariffs. So it's an exciting time for research, unfortunately.
Unfortunately.
But, that's why I study history too. I'm interested in history. It's fascinating, but you can learn things given the variation there. And hopefully the models are durable enough to sustain application. You should write models that have a long shelf life.
We know about that.
Models are, what things have a long shelf life in terms of a durable implication. A lot of our economics
Yeah.
has a long shelf life.
Yes,
That's a
I
good
agree.
thing, right? But you gotta do more than a little jiggering sometimes and build things in that maybe aren't obvious at first.
One other topic I just wanted to bring up, given some of the people in the audience. You work a lot with these tariff data now. You're suffering under 4,000 tariff lines or whatever.
And that we're digitizing the US Census and imports and exports by source and destination. It's a
Wow.
massive, for this period.
Wow.
Yeah.
So, Gary, you might be interested in how we're sourcing our tariff data now and our trade data. the tariff, we worked our way up. When GTAP began, there was someone, he works at the IMF now, but Brad McDonald was copying numbers out of the WTO reports in the early nineties. And that we put those in as MFN tariff rates in the model.
That was chapter 3 of my dissertation.
Okay, very good.
I did 20 products over a decade and a half to show that nominal rigidity mattered.
Yeah.
So the demonstration effect, and I covered maybe 20% of it because I chose sugar as one of them. But no, yeah, we've gotten.
As this framework was starting to be used
Yeah.
in the GATT negotiations now, leading into the WTO, and the Uruguay round, we started getting better access because people using it, but we still had to fight because individual countries like the
So is there
US.
a database you're
didn't
drawing
want-
from?
Yes, so we worked our way up to, finally, WTO started making data available, UNCTAD trades, but now we get it from the Trade Center, the International Trade Center in Geneva, and they're the ones that are out there actually collecting the data in the countries. And so we work with them, filtered through, is it still coming through SEPI?
Is
Or
this, when I had the acronym WITS there, I didn't know my RA went and got, but
no,
it's
it's
different.
we used to.
Yeah, it is, okay. Okay. The other thing too is, not many, if you just ask, average top trader comment, what's the level of US bilateral tariffs in the aggregate or by sector? Right? So, knowing what those numbers are, I didn't, until I unpacked to the sector level, right? To see those agricultural duties sitting there at 40 when the average was 3, it's crucial, obviously. At the sector level, you can capture a lot at the sector level because you know why certain sectors are protected, right? But that's super.
On the trade data, then we have to reconcile imports and exports, and we have to supply a margin, consistent margin that explains those differences between FOB and CIF, and we have to deal with re-exports. So all of those things get sorted out in the data construction process. So just FYI, and there is a time series there now available. So yeah, there may be some.
Yeah, I mean, that is an underutilized, sorts of people here have done a ton of work and Thiago in particular has been making machines run for a long time because he's not just running 2023 or 2019, it's 2017, whatever it goes back, -3, 14, 11,
Was that 2004,
roughly 8, back to 2004. It's all nominal, right, at the time. So there hasn't been any deflation. We don't have any price indices in there. But it is and it's fully consistent, through time.
So,
We're creating, we have to create our own state, US state, because I'm doing state level aggregate. We're creating our own state and product sector deflators.
wow.
Because there's massive terms of trade variation in the interwar period. There's massive effects across the distribution of states that nobody has even talked about. Because, we once took agricultural production deflated by the CPI, so we get a minus 60% real decline. Use the agricultural deflator, it's 10%. So that means that other part is in terms of trade effect. Relative
During the
prices are
Depression,
redistributing.
Yeah.
So it's really crucial. Deflators, I'm very interested in the whole price, don't look at the price side, getting the prices right to deflate. And getting the prices right in terms of a predictive. Sargent used to say back in the day, you have good models of quantities and generally good models of prices. But with the two together, not so easy to explain both prices and quantities, right? It's challenging.
More familiar to us.
Hey, sounds familiar. Especially you, the energy.
Can you speak to two things, background for us? So there's a center that you, for prices and whatnot. What do you do? Tell something about that. Tell something about the December 2 event. You could just briefly promotion, whatever.
So I'll circulate the agenda for the December 2,
Okay.
but it is principally focused on tariffs. So Cavallo's coming from MIT to talk about pass-through at the retail level. He's doing some more work on that, using microdata. And then we have paper on forthcoming paper in the JIE. I keep saying Carolyn Betts. I get the name wrong every time. You see Davis. But they're running, it's forthcoming in the fastest publication track I've ever seen, probably because real-time tariff simulations. So it's looking at each step of the way along on the US tariff profile. What are the effects on the US and abroad? I think it's an Enum Cornum model. I don't know. It wouldn't have input-output relationships. Or if it does, it's gonna be a risk. A lot of these papers, you may use a symmetric roundabout or, so you have to think about what you want to do there, right? Symmetric roundabout is elegant and macro. Sometimes it's used, everything's symmetric in terms of an intermediate input. And then there are others that are more nuanced. I think we should take the production structure as literally as we can from the input tables so we can manage it. That's crucially important. I was down to do the Laffer curve stuff, but I swapped out a paper. I forget what we chose there. I'll send you the program. I think you'll all be interested in at least half, if not the whole thing, based on the modeling and the context. And then the Center for International Prices is a bit esoteric because it's got historical prices, like 1700, 1860 US prices by commodity and city, long run integration. I've got prices, Ecuadorian prices by city and location, city and time and product. What happens when you go through a currency reform and then dollarize to price dynamics? Really interesting. So that's more of a macro-ish thing. But the intent is to a lot of my
You're a repository for these.
it's a
right.
repository, and we're going to add other data sets that other people have cultivated. But a big part of this was my frustration with, the idea that there's no sense in which arbitrage holds in final goods prices across markets. So the nominal exchange rate tells you everything you need to know about the real exchange rate. As in nominal exchange rate changes, no pass through to retail prices. That's exactly the opposite of what we're saying now for tariffs and so forth. It's that sticky price kind of connotation. If you unpack prices, so you go from gasoline to haircuts and everything in between, I've got micro data that does this. It's crude, economist intelligence unit, very crude data. And then what you see is that the retail distribution share, it's quite low for gasoline. It's like 20% of the cost of gasoline is the retail distribution, 80% is gasoline. Go to haircuts, obviously it's the inverse. And then you can use the input-output tables. You want the factor content of retail goods, and the factor content of the traded factor content is equilibrating in terms of not LOP, but something much closer. Then you're conflating with all these segmented, non-traded inputs and retail margins. So you get prices looking very non-responsive to shocks generally. If you unpack the data, you can tease out a much more informative trade and macro kind of intersection that, traded and untraded goods matter and traded and non-traded inputs matter fundamentally for the equilibrium of price dynamics. If you go to a two-sector aggregation, you get a reversion of the mean, and the non-traded relative real exchange rate and the traded real exchange rate look the same. That's Engel JP 91, 2000 citations, wrong. Unpack it. They look very different. Because you're basically aggregating so that they look the same. That's the problem with aggregation.
This whole question about those margins in there is something that we have had versions of the database that have dealt with margins, but really haven't maintain that. Super important for all the reasons you're mentioning. I mean, that's another direction that Channing might think about going.
It's been near and dear to me for a while.
Yeah, Mozambique.
Yeah, where the margins
What was
were.
the margin between the farmer and the?
It was more than, about the same as the price,
Well, we know the Penn effect.
What's that?
That you double, they say double income prices rise by a factor of half. That's the 50% slope. Price, income levels and price levels. The way you should think about it, a better way to think about it is wages on the x-axis and prices on the y-axis. So if you're trading, there should be no correlation between your wage level and the prices. That's law of one price. So the Penn effect is the idea that when your wages rise by a factor double, prices only increase by a half. I interpret that actually as the retail and distribution margin to a first order, right? Because that doesn't that doesn't satisfy the law of price. When you start to unpack at the micro level, haircuts are a 45 or whatever your unskilled labor is, wage to wage.
Right.
The traded goods have a zero slope.
Right.
I have a paper in the JME that does this in the long run for every good in that EIU data.
Sure.
That slope parameter is that retail distribution cost share. So that's an important part. Of course, there's also markups in terms of the true IO cents. Those are a little harder to unpack because you really need a model. The true retail distribution costs. You know, I think still today, 35% of US value added is retail. That's an important part of the value added.
We need to wrap up here.
Yeah.
Last point, what courses do you teach? I mean, it's super interesting.
The
stuff you're doing.
PhD course at the upper level, which is now, it used to be business cycle, international business cycle focused. Now it's more trade, tariffs and trade diffusion. It's some business cycles, so it's getting more
Very
adjacent to
interesting,
this.
very interesting. for us.
Are you teaching?
Utaro,
Mod one.
yeah, Utaro, get in there.
Okay, well.
Thank you very much.
What a great get
At
to
least
know you.
start more
Yeah,
conversations.
yeah. No, there's no doubt about it. We've gotta interact.
Thanks a lot, Martin.
Yeah.
So, I'll concentrate a bit, which I'm good at, and we'll get back.
Okay.